UG Healthcare is primarily a OBM, own brand manufacturer, manufacturing and distributing medical disposable latex gloves. Globally, we have 6 downstream distribution centers and companies located in key markets, 3 in developed markets, UK, Germany, and the US, and 3 in the emerging markets of China, Brazil, and Nigeria. In each of these 6 local markets, we own and operate our own downstream distribution that includes our own local sales and marketing teams, warehousing, logistics, and distribution infrastructure. Our production factories are located in Seremban in the state of Negeri Sembilan in Malaysia, which is very close to about an hour's drive from Kuala Lumpur. Currently, our production capacity is around 2.9 billion piece, of which 85% is produced and sold in our own brand Unigloves through our 6 distribution centers. We have a few phases of expansion capacity coming up. We are adding 500 million pieces by March and about 1.2 billion pieces by mid-year of this year. That will bring us to a total of 4.6 billion pieces. That represents about 60% production capacity growth from our current capacity. Next slide, please. This slide shows the location of our 6 distribution centers. We are strategically located in the key emerging markets as well as developed markets. Unlike the more OEM factories, we sell primarily our own brand, and in each market, we have about 1,000 or over customers. They are primarily small to mid-size local distributors as well as end users. So given our relatively small manufacturing size, we do have a very large, strong, diversified, stable base of customers of over 5,000 customers that forms the bedrock of UG's customer base. Next slide, please. This slide shows some snapshots of some of our distribution centers in the overseas market, from Nigeria to Brazil to Europe, where we run our own distribution logistics as well as holding stocks for warehouses that we own and operate, as well as our local and sales marketing teams. Next slide, please, Anisha. In each of the markets where we actually market and sell directly to end users, we participate and have organized our own local marketing campaigns, from participating in trade shows as well as direct education to end users to raise awareness for our brand. So we do put a lot of emphasis and invest in a lot of infrastructure costs on the sales and marketing side, therefore generating from pre-COVID a fairly high overheads for our company. Next slide, please. We also use social media as a way to promote our brand in the various markets, from Instagram to WeChat and to various other social platforms, for us to widen our customer base that create the stickiness and brand awareness for our own brand products. Next slide, please. Again, this shows a snapshot of our integrated own brand model, from upstream manufacturing to downstream distribution and direct supply chain to the local distributors and end customer base. Next slide, please. This shows our Q1 FY 2021. Our year end is in June. So on the right-hand side pie chart, you can see our revenue breakdown. And on the left-hand side is our FY 2020 revenue breakdown. Europe represents our largest market, is about 40% of our revenue, followed by Brazil, which is about 30% of our revenue. Asia, which is primarily China, and Africa, which is primarily Nigeria, are also key growing markets. One of the markets that we are not so devoting so much resources is North America. The reason is because in North America, the distribution structures are quite entrenched and are dominated by big distributors in the US. So it's quite difficult for sort of non-US players to actually break into the distribution structures. So we like places like Europe where the distributors and the customers are all primarily small to mid-size companies, traders, and the market is more fragmented. That allows cross-selling between European countries as well as between different sectors or industries. Similarly to emerging markets like Brazil and Nigeria and China, where distributions of medical products is still very fragmented. So we like these kind of markets where we have the edge in terms of local sales, intelligence, and marketing for us to expand our distribution network. Next slide, please. Again, this is captures the key revenue breakdown of all our key markets. Biggest growth since pandemic started to now has come from all our key markets, including Europe and Brazil. Also Africa and Asia, where we have registered more than 100 and over 100%, 200% growth in all the key markets. Next slide, please. The reason why UG focuses so much on emerging markets, as I have explained in the last few slides, is because there is so much potential for hygiene awareness and safety protection in these markets. So as you can see, this graph represents a glove consumption per capita. All the emerging markets are at the right-hand side at the bottom, such as Russia, Brazil, China, India, etc. And of Africa would fall there too. And on the left-hand side, the higher charts are the more developed European and US markets. So, since the pandemic started, what we have realized is that actually a lot of users in emerging markets are currently A, not using gloves, or B, not using the right gloves or using low quality gloves, or C, in many industries, they are repeating usage of gloves. So this represents an opportunity for glove makers that actually have entrenched network in these countries to grow your own brand and to expand into new markets beyond just the medical sectors. Of course, Europe is a very stable market for UG, but we see where our resources that we have plowed in the last few years has been really into the emerging markets, where we see the growth to be more substantial in the coming years. Next slide, please. This is a chart from the Malaysia Rubber Gloves Manufacturers Association that projects the demand of gloves post-pandemic. As we know, of course, in the last 1 year, the glove demand has soared, outstripping supply by a large margin. But we expect this usage to be entrenched as I mentioned, going to be driven by especially by the emerging markets. Places like China or Brazil, where people are becoming wealthier and able to afford a more better quality products, and this will actually drive the glove demand into exponential post-pandemic. Next slide, please. This is a picture of one of our manufacturing facilities in Malaysia. What I would like to show is that on the bottom left corner, a piece of land that is in green with trees, that is the land that we have acquired back in September for the expansion capacity that will bring us to 4.6 billion. So that land itself we are adding about 1.2 billion pieces of capacity by June. So this picture was taken probably a few months back. So in the next slide that you'll see, Anisha, this is currently what the land now looks like. This actually also about 2 months ago. So now, if you see the land now, you will see some structures being put up in anticipation of the production lines to be set up. So this land itself will bring us to an additional 60% increase in production capacity by this year to cater for our own market's growth. Next slide, please. This is a production chart of how we have grown in the last 7 years. We anticipate the production growth to be production capacity increase to be primarily driven to our own brand markets. Yeah. Next slide, please. This chart shows our Q1 results. I think this is a little bit old. Our Q2 results will be coming out shortly in early February. So as you can see, reason bottom left-hand chart, the profit before tax, we have actually invested a lot in our overheads in the last few years to build our own distribution centers, which we need to invest in sales and marketing, overheads, logistics, warehouses. Our gross margin is still around 20%. As you can, so in the next slide, Anisha, you will see that our gross profit margin for the last 6 quarters or 8 quarters has always hovering around 20%, which means that actually we are achieving the kind of gross profit margin that the industry is looking at. Reason for our smaller net profit margin the last few years is actually due to our heavy investment in overheads. So what it means is that any additional volume that we are going to add, we are actually going to achieve economy of scale. So this additional 60% of capacity that we'll be adding is going to come at a scale on the overheads that we have already invested in. So there's been discussions on kind of why how Glove, how UG will perform post-pandemic. Are we going to go back to our pre-pandemic profit margin? I would say the answer is no. Is because the reason is because pre-pandemic UG's margin was low, net margin was low, is because of high administrative overheads, which we will now, the pandemic has allowed us to increase the capacity to scale up to a level whereby we can actually move beyond the overheads and cover that and beyond that. So, yep. Next slide, please. This is the balance sheet position as of 30th September, which is 2 months ago. We are at a net cash position. As you can see, as we wind down this quarter and next quarter, our short-term bank borrowings will become very minimal, and we should be able to be in a much stronger net cash position. So that's the end of my brief presentation. Thank you.